Real estate economics, how the investment machine actually works. Most people treat real estate as finding a cute house, placing a tenant, and collecting rent. Professionals see it as an economic machine: borrow, debt, buy the asset, property, and place a tenant between the two to service the cost of capital. When the machine works, it creates wealth; when it fails, it destroys investors who ignore the underlying math. The key metric is the spread, the difference between your cost of capital, interest rate, and the asset's yield, ROI. Positive leverage occurs when borrowing costs are lower than the asset yield; negative leverage occurs when borrowing costs exceed yield. Right now many investors face negative leverage, borrowing at rates higher than property returns, creating monthly losses and turning appreciation hopes into gambling. Understand inputs and outputs. The input is the cost of capital, the output is the property's cash yield. Buy based on current operations, not assumptions of future rent growth, expense cuts, or appreciation. Successful investors buy wholesale, priced for today's economics, and apply rigorous underwriting. If markets produce negative leverage, manufacture the economics, perform value-add work that increases net operating income, renovations, in-unit amenities, better management, higher occupancy, so the spread becomes positive. Value-add strategies can transform an unprofitable asset into one that covers debt and produces returns. Inflation and fixed debt tilt the math in your favor over time. A long fixed mortgage keeps payments stable while rents and nominal cash flow often rise, preserving and growing real returns. That long duration edge is central to wealth creation via real estate. If you seek leveraged upside, consider also owning high-quality, cash-flowing properties and operate them like a business rather than a passive gamble. Avoid buying purely for appreciation. Buy assets that generate immediate returns or where you can reliably create them through proven upgrades and improved operations. Practical rules. Always test deals with current numbers, not forecasts. Avoid negative cash deals funded by hope. Target purchases where your post-finance cash flow is positive or where a clear, low-risk value-add plan restores positive leverage. Treat real estate as an operating business, improve the product, solve tenant problems, and capture the spread. Real estate wealth comes from disciplined underwriting, aggressive but realistic value creation, and respect for the cost of capital. If the math doesn't work, don't buy.